Have you ever wondered why banks ask for collateral when you apply for a loan? Well, there's a fascinating world behind this question, and it's all about mitigating risk and securing trust. Let's dive into the intriguing world of collateral. So, what exactly is collateral? In the simplest terms, it's something of value that you, the borrower, offer to the lender as a form of security. Think of it as a safety net, a cushion if you will, that the lender can fall back on if you default on your loan repayments. This could be anything from your car or house to stocks or bonds. Now, to paint a clearer picture, let's consider a scenario. Imagine you're a lender and you have two potential borrowers. One has a stable job, a good credit history, and offers their house as collateral. The other, however, has a shaky financial history and offers nothing as security. Who would you be more inclined to lend to? The answer is pretty straightforward, isn't it? This is the same logic that banks and other lending institutions use. Collateral provides them with a safety net, ensuring that they have something to fall back on if the borrower fails to meet their repayment obligations. It's a way of securing their investment and protecting themselves from potential losses. But it's not just about the lenders. Collateral also plays a vital role for borrowers. By offering collateral, borrowers can often secure better loan terms such as lower interest rates or higher borrowing limits. It's a way of demonstrating credibility and commitment, showing the lender that they're serious about repaying the loan. However, like most things in life, collateral isn't without its pitfalls. There's always the risk of losing the asset if the borrower defaults on the loan. But that's a story for another day. In the end, the concept of collateral is a balancing act, a dance between risk and security, trust and commitment. It's a fundamental part of our financial system, shaping the way we borrow and lend. Now, you might be wondering, why is collateral so important to lenders? To understand the significance of collateral, you first need to understand what it really is. At its core, collateral is a form of security. Imagine you're at a coat check at a fancy event. You hand over your coat, and in exchange, you receive a token. That token is a form of collateral. It's an assurance that your coat will be safe and returned to you when you're ready to leave. In the financial world, collateral works in a similar way, but instead of coats and tokens, we're dealing with loans and assets. Collateral could be any asset that a lender accepts as security for a loan. It serves as a form of protection for the lender. Should the borrower default on their loan, the lender has the right to seize the collateral to recoup some or all of their losses. Now, you might be wondering what qualifies as collateral. Well, it can be a wide range of assets such as property, vehicles, or other valuable items. For instance, if you're taking out a mortgage to buy a house, the house itself often serves as the collateral. If you fail to make your mortgage payments, the lender could seize your house through a process known as foreclosure. Similarly, if you're getting a car loan, your car would be the collateral. And in the case of a business loan, a company might use its equipment, inventory, or even its accounts receivable as collateral. The nature of collateral is that it's something of value, something that can be sold or used to recover funds in case the borrower can't pay back the loan. It's a safety net for the lender, and it's what makes many types of loans possible in the first place. However, it's crucial to remember that while collateral provides security for the lender, it also carries risks for the borrower. If you're unable to repay your loan, you could lose your collateral, which is often a significant asset. Now that we have understood what collateral is, it's time to explore why it's such a crucial part of the lending process. Why do lenders insist on having collateral? What purpose does it serve? These questions lead us to explore the significant role of collateral in the world of finance. At its core, collateral serves as a form of protection for lenders. When you borrow money, whether it's for a new car, a house, or to start a business, lenders need some assurance that they'll get their money back. Enter collateral. This tangible asset, be it a piece of property, a car, or stocks, acts as a guarantee, a pledge that the borrower will repay the loan. Imagine lending money to a friend. You'd feel more secure if they offered something valuable as insurance, wouldn't you? That's exactly how lenders feel. The collateral provides them with a safety net, a buffer against the financial risk they take when they lend money. But what happens if the borrower cannot repay the loan? This is where the concept of default comes into play. Default is the failure to repay a loan according to the terms agreed upon in the contract. In the unfortunate event of a default, the lender has the right to seize the collateral. This seized asset can then be sold off to recover the outstanding loan amount. However, the process isn't as straightforward as it sounds. The sale of collateral involves legal procedures and can be time-consuming. Plus, the market value of the collateral might have decreased over time, leading to a potential loss for the lender. Nonetheless, the presence of collateral still offers a safety layer, a form of assurance that the lender won't be left high and dry. In essence, collateral acts as a safeguard against the unpredictable nature of financial transactions. It gives lenders the confidence to lend large sums of money, thereby facilitating economic growth and enabling borrowers to achieve their dreams, be it owning a home or expanding a business. But there's more to collateral than just being a safety net for lenders. Stay tuned as we delve deeper into the pros and cons of collateral in the next scene. While collateral might seem like a one-sided affair favoring the lenders, it has its pros and cons for both parties involved. Let's delve into the advantages first. Collateral can be the golden ticket for borrowers seeking larger loans. It's like waving a shiny object in front of a magpie. Lenders, in this case the magpie, are more likely to lend larger sums when they have the assurance of an asset backing the loan. In a way, collateral acts as a safety net for lenders, mitigating the risk associated with lending substantial amounts of money. Now, what's in it for the borrowers? Well, besides opening the door to larger loans, collateral can also pave the way for lower interest rates. Lenders tend to offer more favorable terms when they have the reassurance of an asset. So it's a win-win situation, right? The borrower gets the loan they need, possibly at a lower interest rate, and the lender gets the security they crave. However, every rose has its thorn, and collateral is no exception. The most significant downside is the risk borrowers undertake. If a borrower finds themselves unable to repay the loan, they could potentially lose their assets. It's like playing a high-stakes game of poker where you're betting your house, car, or other valuable assets. The risk is real, and the consequences can be harsh. Another downside can be the time-consuming process of valuation and documentation of the collateral. This can stretch out the loan approval process, adding an extra layer of complexity. In some cases, borrowers may also feel pressured into accepting unfavorable loan terms due to the fear of losing their collateral. This can lead to a cycle of debt that is difficult to break free from. As you see, collateral plays a significant role in the lending process, but it does come with its own set of challenges. So the next time you consider using collateral, weigh these pros and cons carefully. It's a decision that could have a far-reaching impact on your financial future. Now that we've explored the concept of collateral, its role, and its pros and cons, let's summarize our discussion. Collateral, in essence, is a form of security, a kind of insurance policy that lenders use to minimize their risk. When a borrower pledges an asset as collateral, it gives the lender the assurance that they can recover their money, even if the borrower defaults on the loan. This assurance can often make loans accessible to borrowers who may not have been able to secure them otherwise. But collateral isn't just about making loans more accessible. It's also about understanding and managing risk. For lenders, the value of the collateral helps determine how much they're willing to lend. If the collateral's value is high, they may be more willing to lend a larger amount. Conversely, if the value is low, they may restrict the loan size. For borrowers, understanding the value of their collateral is crucial. It can affect the terms of their loan, including the interest rate and repayment schedule. Moreover, understanding the potential risk of losing their collateral if they cannot repay the loan is paramount. And let's not forget the two-sided nature of collateral. It can be seen as a boon or bane. On one hand, it provides access to larger loans and potentially better interest rates. On the other hand, there's always the risk of losing the pledged asset, which could have a significant financial and emotional impact. Collateral is a tool, and like any tool, it's neither inherently good nor bad. Its value lies in how it's used. Used wisely, it can open doors and create opportunities. Used unwisely, it can lead to financial distress. The bottom line is, understanding collateral is essential. Whether you're a lender assessing risk, a borrower looking to secure a loan, or an investor considering a secure debt investment, it's about more than just assets and loans. It's about understanding the landscape of risk and reward and making informed decisions. Remember, collateral is not just about securing loans, it's about understanding the risks and being prepared to manage